When people talk about investing in U.S. stocks, the conversation often centers on individual company names. Investors debate which stock is the best, which one will grow fastest, or which company will outperform next. Professional investors approach U.S. stocks very differently. This video explains how professionals think about U.S. stocks within a portfolio, why individual company quality is only one part of the equation, and how risk management and position sizing shape investment decisions. This is not a recommendation and not financial advice. It is an educational overview of how professionals structure exposure to U.S. equities. One of the most common mistakes retail investors make is treating U.S. stocks as isolated bets rather than components of a portfolio. A company can be strong, profitable, and well managed, yet still be a poor fit if the allocation is not sized correctly. Professionals begin with the role U.S. stocks play in the portfolio. For most investors, U.S. equities represent the core growth engine. They provide exposure to large, diversified companies operating across technology, healthcare, consumer goods, finance, and industrial sectors. However, not all U.S. stocks serve the same purpose. Some are growth-oriented, some generate income, and others offer defensive characteristics. Professionals categorize stocks based on function, not popularity. Another key distinction is between individual stocks and broad market exposure. Many professional portfolios use U.S. equity ETFs to establish core exposure. This provides diversification, liquidity, and low-cost access to the overall market. Individual stocks are typically layered on top of this core exposure. They are used selectively to express specific views or tilt the portfolio towards certain sectors or characteristics. Position sizing is central to professional investing. No matter how strong a company appears, professionals rarely allow a single stock to dominate portfolio risk. Large positions increase drawdown risk and can distort portfolio behavior. Instead of asking how much upside a stock might have, professionals ask how much damage it could do if it underperforms. This mindset shifts the focus from prediction to survival. Risk management is not about avoiding volatility. It is about ensuring volatility does not threaten long-term objectives. U.S. stocks can experience significant swings, even among well-established companies. Professionals expect this volatility and design portfolios accordingly. This includes spreading exposure across sectors, controlling position sizes, and avoiding excessive concentration in a single theme. Another important consideration is correlation. During market stress, many U.S. stocks move together regardless of company fundamentals. Diversification within U.S. equities helps, but it does not eliminate risk. Because of this, U.S. stocks are evaluated in the context of the entire portfolio, including international equities, fixed income, and other asset classes. The goal is balance, not perfection. Rebalancing plays a key role in managing U.S. stock exposure. As certain stocks or sectors outperform, their portfolio weight increases. Professionals periodically trim positions to maintain balance and control risk. This process is not driven by headlines or short-term predictions. It is driven by discipline and predefined allocation targets. Time horizon also matters. Professional investors evaluate U.S. stock exposure over multi-year periods. Short-term price movements do not automatically prompt action unless they change the underlying role of the investment. This long-term perspective allows professionals to avoid emotional decision-making during market volatility. The key takeaway is that professionals do not view U.S. stocks as lottery tickets or popularity contests. They view them as tools within a broader system. A strong company does not guarantee strong results if it is poorly allocated. Conversely, a modest position in a strong business can contribute meaningfully to long-term portfolio performance. For individual investors, the lesson is not which U.S. stocks to buy, but how to think about stock exposure. Clear objectives, controlled position sizes, diversification, and discipline matter more than finding the next winning name. This framework applies whether the focus is U.S. stocks, international markets, or any other asset class. Markets change, but process remains constant. This content is provided for educational purposes only and does not constitute financial advice. For additional educational content on portfolio structure, risk management, and global market exposure, explore the other videos on this channel.